In this video, we'll be covering the concept of a balance sheet, also known as the statement of financial position. To make things more engaging, I'll walk you through a fun story about starting a business that naturally explains the concept of a balance sheet. But before we dive into that, let's go over the basic theory. In our previous video, Bob's Story, we explored the accounting equation. Accounting equation, assets minus liabilities equal owner equities. If we move the liabilities to the other side of equation, we will have balance sheet equation. Assets equal liabilities plus owner equity. The balance sheet equation is a formula that sets out the relationship between assets, liabilities, and equity. The stuff that a business owns, assets, is equal to the stuff that a business owes, liabilities, and owner equities. Equity is the stuff that a business owes to its owners. It's what remains after all debts and obligations have been settled. An asset is anything of value that an individual or business owns. Assets can provide future economic benefits by generating revenue or being converted into cash. They are classified into different categories. Current assets, or short-term, easily converted into cash within a year. For example, cash and cash equivalents, money in hand or bank accounts. Accounts receivable, amounts owed by customers. Inventory, goods ready for sale. Prepaid expenses, payments made in advance, rent, insurance. Non-current assets, or long-term, used over multiple years. For example, machinery and equipment, buildings, land. What are the sources of funding for acquiring these assets? How did we buy these assets? One source is the owners of the business, who invest their personal funds. This is known as equity. However, for most startups, owner capital isn't enough. They often require additional financing, like a bank loan. This is known as liability. That is how we end up with balance sheet equation. Assets equals liabilities plus equity. That forms the foundation of financial statements. Financial statements. A financial statement is a formal record of a company's financial activities and position over a specific period. It provides insights into a business's financial health and is typically used by investors, creditors, and management to make informed decisions. There are three primary types of financial statements. The balance sheet, which shows what a company owns and owes. It shows a company's assets, liabilities, and shareholders' equity at a particular point in time and track company's financial health. The income statement, which details the company's revenues, expenses, and net profit or loss over a given period. The cash flow statement, which details the movement of money, tracks the inflows and outflows of cash, categorizing them into operating, investing, and financing activities. Now enough theory. Let's dive into Alex's Bakery, story about starting his business that naturally explains the concept of a balance sheet. The tale of Alex's Bakery, a business in the making. Alex had always dreamed of opening a bakery. Fresh pastries, the smell of warm bread in the morning. It was a passion they had nurtured for years. But turning that dream into reality meant understanding business finances, especially the balance sheet. The beginning, assets and liabilities. To get started, Alex needed cash, but where would it come from? Where does this money come from? First, Alex invested $20,000 of personal savings. This money became equity, the owner's stake in the business. Next, Alex secured a bank loan of $30,000, an amount to be paid back over time. This was a liability, a financial obligation. Here's something important. The equity doesn't exist as a physical asset. It's simply a calculated value derived from total assets minus debt. Equity isn't a physical asset, it's just a calculation. It's determined by the accounting equation, assets equals liabilities plus equity. If we rearrange the equation we have, equity equals assets minus liabilities. The more assets we have and the less debt we owe, the greater our equity grows. At this point, Alex's balance sheet looked like this. Assets, cash of $50,000, the combined savings and loan. Liabilities, the $30,000 loan. Equity, the $20,000 of personal savings invested in the business. Investing in the business. With funds ready, Alex needed equipment, an oven, mixers, display cases, and raw ingredients. $15,000 went into buying bakery equipment. $5,000 was spent on flour, sugar, and other supplies. Now the balance sheet changed. Cash reduced to $30,000 after spending $20,000. Inventory, ingredients, worth $5,000 was added to assets. Equipment worth $15,000 also became an asset. Operations begin, expenses and revenue. Alex finally opened the bakery's doors. Customers flocked in, eager to buy freshly baked goods. Over the month, he uses $1,000 value of ingredients to bake. This reduces inventory. $5,000 minus $1,000 equals $4,000. Sales brought in $12,000. This increased cash. Beginning balance of cash was $30,000 plus $12,000 sales during the month equals $42,000 our cash balance. Operating expenses, rent, wages, utilities amounted to $4,000, reducing cash. $42,000 cash minus $4,000 expenses equals $38,000 our final balance at the end of the month. At month's end, the balance sheet showed assets, cash $38,000, equipment $15,000, inventory $4,000. Liabilities, still $30,000 loan. Equity, $7,000 increase due to profits earned. Now his equity is $27,000. Total asset $57,000 minus total liabilities $30,000 equals $27,000. Understanding profitability. Alex's business was thriving, but how could profitability be measured? If the total assets exceeded liabilities, it meant Alex's bakery was growing financially. The formula was equity equals assets minus liabilities. Over time, as loan payments reduced liabilities and profits increased assets, equity grew, proving the bakery was successful. If you compare the balance sheet on the 1st of January when Alex started his business with the January 31st after 1 month of operating the bakery and create revenue, you can see how owner equity and cash increased. Alex's journey showed that a balance sheet isn't just numbers. It tells the financial story of a business. It tracks where money comes from, equity, loans. Where it's spent, equipment, expenses. What remains? Assets versus liabilities. By keeping the balance sheet updated, Alex could make smart decisions, expanding, investing, or adjusting business strategies to ensure long-term success. And so, Alex's bakery flourished, all thanks to understanding the balance sheet's power in running a business. And that's how Alex's bakery flourished, all thanks to understanding the balance sheet's power in running a business. I hope you enjoyed the story. A practice file is provided in the following video. Please watch the practice video to better understand the concept of balance sheet. If you enjoyed this video, don't forget to hit that like button. It really helps the channel grow. Share this with your friends who might love this too. And if you haven't already, subscribe and turn on notifications so you never miss out on exciting new content. Your support means the world to me, and I can't wait to keep bringing you more.